Hello and welcome to this session in which we will discuss Treasury Inflation-Protected Securities, known as TIPS. Now, before we discuss TIPS, we need to understand the purpose of these Treasury Inflation-Protected Securities. So I'm going to start with a simple example to illustrate this concept. Let us assume that you can buy a 20-year Treasury bond that pays 8% in a coupon rate and you have $1,000 to invest. What would happen is you will receive $80 each year for the next 20 years. And that money, remember, is guaranteed. Why is it guaranteed? Because it's a US Treasury bond and the US has a zero default rate. Therefore, it's guaranteed you will get your $80. It's guaranteed that you get your $1,000. And at the end, you will get your money back. Everything is all and well. Now, is this a risk-free investment? And the answer is yes. You'll get $80 every year and you'll get your money back. No ifs and buts about it, because the US government can raise taxes to pay you or they can print money. So you are secured from that perspective. From a nominal account, you are a secured investor. How about let's think about this, and let's assume you're going to take this $80 every year and buy a pizza, and each pizza is $10. So what happened is every year you are going to buy 8 pizzas. Why? Because each pizza is $10. You can buy 8 pizzas with this revenue and enjoy your $80 by eating pizzas. That's fine. That's year 1. How about in year 2, 3, and 4? Let's assume by year 4, what happened is the price of the cheese went up, the price of the dough went up, and now the pizza is costing you not 10. The pizza is costing $15 per pizza. What would happen under those circumstances because inflation went up? Well, let's see what would happen if you have $80 from Uncle Sam and now the pizza will cost you $15. How many pizzas can you purchase with that same amount of money that's guaranteed money? Well, the answer is 5.33. No one's going to sell you 5.33. We're going to say 5 pizzas and you're going to keep some change. Wow. So you see what happened to the pizza? Your utility of that money went down. Why? Because the prices went up. Why do prices go up? We're going to assume it's inflationary pressure. Because of inflation, prices went up. As a result, what happened to that $80 that's supposed to be risk-free investment? It's now subject to, you guessed it, inflation risk. So in this session, we are going to discuss an investment vehicle called Treasury Inflation-Protected Securities, or TIPS, that will allow you to protect against inflation. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com.
Our corporate finance course is best for online students and students who are taking corporate finance courses. We cover financial statements, discounted cash flow, stock valuation, bond valuation, NPV and capital investment decisions, cost of capital, risk and return, as well as other topics. Our course includes lectures as well as multiple choice questions. Go ahead and start your free trial today. No obligation. We are here to help. Your success starts here.
So to avoid inflation risk, the US government issue the Treasury Inflation-Protected Securities. And what do we mean by this? It means the bond pay interest and principal in real terms, meaning they get adjusted to inflation. So you have $1,000 and inflation went up by 3%. You would adjust your balance by 3% and your payment is based on that. Also, remember, if we have deflation, that's also going to decrease as well. So keep that in mind, that it could be inflated or deflated. So keep that in mind, but you are protecting yourself against inflation. If it's deflated, that's fine. If everything else goes down in price, you are in the same boat, but your risk is inflation. And there are several other countries beside the US that offer those similar indexed bonds. So the best way to illustrate this is to actually look at an example. Let's assume you can buy a $1,000 Treasury Inflation-Protected Security with a 3% coupon and an inflation of 2%. At year end, you would receive adjusted a principal of 1,000 plus, remember, we have to inflate this amount. The amount is inflated by 2%, 1,020. That's the value. Now this 1,020 is applied to the 3% coupon. Therefore, you received $30.60. Now you might be saying, what's the alternative if I did not have this protection? The alternative is you would have received $30. This additional 60 cent. Now you might be saying, hold on a second, what's the big deal about 60 pennies? We're not talking about 60 pennies. Add zeros, then 60 pennies makes a difference. So the 60 pennies is what? The 60 pennies accounted for the inflation because your investment, this $1,000 became 1,020. So this additional $20 earned also 3%. Therefore, you received an extra 60 pennies. Therefore, your investment grew at inflation rate. So, going back to the pizza, so let's assume your plan, the pizza price when you invested your money was $30. Okay? Then you say, okay, I'm going to invest this money, get $30 and buy the pizza. And enjoy that pizza because that's what I want to do with my $30. But if the pizza prices now went up by 2% and now it became $30.60, guess what? You're good because your investment also paid you $30.60, which in turn allow you to enjoy that pizza. So this inflation protected security help you do what? Protect your asset. What should you do now? You want to go to Farhat Lectures, look at additional resources, multiple choice lectures. That's going to help you whether you are an accounting student, CPA exam candidate, finance, CFA, CMA. The best investment you can make is invest in yourself. Good luck, study hard, and of course, stay safe.